Market Michael here. Okay, so let's just give you the data and then break it down. So 8:30 data, GDP 2.3%, expected 2.1. Analyst from the Wall Street Journal expected 1.8. I expected 1.8, 1.9. 2.3 is a big gain. Um, it is less than 2.9% of Q4. I believe Q1 is typically less, is the weakest data here. So, but we are seeing year-over-year declines of that of Q1 GDP. And responsible for this bad GDP number was consumer spending slowdown. So the chain deflator came in positive, but we did get a decrease from the prior. I don't know how they measure it, whether it's quarterly or weekly. I believe it's quarterly. So let's just say, you know, I, oh, it's a miss. It's a miss for that chain deflator. I don't know why I said we hit it because it's expected 2.2. So we got a bigger expected drop for that chain deflator, and employment cost index decreased. Um, Increased. So it costs more to employ the people. That's for sure seeing that inflation in wages, and we are just gonna wait for that 10 o'clock, 9:45 and 10 o'clock information. So let's get into this information. So let's talk about the GDP at 2.3% in the first quarter. So I'm going to read this from my handy dandy source here. GDP, value of all goods and services in the U.S. adjusted for inflation, rose to 2.3% from January through March. Weaker consumer spending was behind the moderate slowdown in growth in the fourth quarter, when output grew at 2.9% rate, increasing after increasing 3.2% in the third quarter. Compared to the first quarter a year ago, output grew 2.9%. So we are seeing those slowdowns. Household outlays increased at 1.1% rate in the first quarter, pulling back from the fourth quarter, which they rose 4%, and marking the smallest increase since mid-2013. Economists had expected some moderation in consumer spending after last year's bumper holiday spending season, and rising inflation also cut into America's paychecks. It's true, oil as well as rising inflation. 1.5 trillion tax cuts were supposed to do 3%, but did not. I was very surprised for us to get 2.3%. I thought we were getting well under the 2 handle. Friday's report, the first reading on GDP since the tax overall, suggests the initial inputs were subdued, though the full impact won't likely be felt for years. First quarter's has a tendency to be weaker than other quarters, but when we have year-over-year declines, that indicates a negative momentum, and also this is them being extra bullish, saying the first quarter growth tended to be weaker than other quarters, potentially from seasonal quirks in the data that dissipate in subsequent months, which is not the case. Slowdown in consumer spending in the first quarter offset more positive developments like continued momentum in business investment and a rise in U.S. exports. But the business development is unfortunately, and first of all, the rise in exports was just 1 month, guys. Our deficit rose for the first time. Decreased for the first time, in a while. That's not really likely to continue as a trend. So this article is completely backwards, and that's why, like, when I wanted to cover the beige book, it didn't really make any sense because that beige book is it's not propaganda, but it's not telling it how it is, but it is at the same time. So what we're seeing here is that the we are slowing down, and the major engine for this economy is slowing down, which is consumer spending. Let's check this out. The slowdown in consumer spending in the first quarter offset the business developments. Outlays for durable goods, big ticket items like cars, dishwashers dropped 3.3% rate, the steepest decline since '09. Not good. Durable goods edged up slightly. Non-durable goods. No, it was just the freaking airplanes. Uh, airplane that brought the durable goods number good. A key category of business spending moderated slightly from the fourth quarter, but remained robust. I wouldn't say that. Non-residential fixed investment reflected spending on commercial construction, somewhat true. Equipment and software rose at a 6.1% rate. Capital expenditures were led by 12.3% growth in spending on structures. Again, you know, it's not that we have super cheap money. It's just that we are at a point um, where it's easy for companies to go ahead and do this. Because if you make developments, if you do this stuff, it should, in theory, raise your um, sales. But when consumer spending is just decreasing because money velocity is decreasing, then what we're actually seeing is a pullback. And the slight pullback in the pace of business investment from the fourth quarter could have been due to the strong incentives businesses had to invest in the fourth quarter of last year before the corporate tax rate declined from 35 to 21. Deductions were more valuable against their higher rate. In December's tax law allowed companies to make immediate write-offs for certain capital expenditures made after September 27th. The housing sector stagnated in 2018 as residential investment was flat, in a development that reflected higher short-term interest rates and tax code changes that diminished decade-old perks that encouraged home ownership. Again, when the cream de crop of lending is going down, home ownership, then we're gonna see some major problems with the derivatives markets. Government expenditures was up 1.2% annually in the first quarter. Net exports added 0.2% to the quarter's GDP of 2.3%. Exports increased at 4% rate in the first quarter, while imports rose at 2.6%. I mean, what are we exporting, guys? Soybeans? Like, I mean, a measure of overall inflation rose. The price index for personal consumption expenditure increased at a 2.7% pace in the first quarter, marching the fourth quarter's pace. Core prices, which exclude food and energy, rose at 2.5%. So, again, that's we're over 2.7. Current expansion began in the mid 09s, is the third largest on record and set to become the second largest in May, but also been stubbornly stuck in a modest pace, slower than the expansions in the 20th century. Weak consumer spending so far this year jars with surveys that showed consumer spending remained relatively high in the first quarter as tangible evidence of tax cuts began showing up in Americans' bank accounts due to lower payroll withholding. But again, guys, it's you're spending more money on your goods. So, of course, consumer spending is going to be slightly higher because you have inflation. Ahead of the Friday's report, economists noted that strong fourth quarter might have prompted households to put off spending early this year. Concerns about rising borrowing costs and the Trump administration tariffs on steel also fueled market volatility. No, it didn't. It's a bunch of bullshit. Don't listen to the fake news. Federal Reserve policymakers indicated at their most recent policy meeting that they expect to continue gradually raising rates short term as the economy grows. Officials voted unanimously last month to raise their benchmark federal funds rate by a quarter percentage point to range between 1.5 and 1.75, and they penciled in 2 further increases for the year. Although pace of consumer spending slowed in the first 3 months of 2018, the unemployment rate was as low as 4.1% throughout the quarter. A strong labor market combined with tax reform suggests economic growth should pick up in the further coming quarters. So we are relying on more growth from businesses due to consumer spending, due to more hiring. Let's just see if that ends up being the case here. I really wouldn't expect it to so much. That was a really good detailed report. Um, so again, let me see if I can find an article with that chain deflator. We are supposedly the consumer sentiment is at 98 again. Um, so I don't have anything on that. Well, okay. Let me see if there's anything. Supposedly a preview of the consumer center. I just told you that. So with the cost of employment going up, it's going to be more difficult to continue to hire workers and continue to maintain those workers if they think that this labor market is going to go higher, based on uh you know based on future gains that aren't necessarily there. I don't know. And again, they always try and spin the data. So let me see if I can get the information on chain deflator and employment index. Let's do the employment cost index. Oh, God. April 27th. Okay. Compensation for cost of civilian workers increased 0.8%, 0.9% with benefits. Oh, benefits increased 0.7%. Wages and salaries up 0.9%. So again, we are seeing that increase in wage inflation, which will cause inflation in goods, which will increase the consumer spending because you're spending more on those goods. I don't think there's any more explanation or any more information we need to know. We saw that information there, but we actually want to just look at that chain deflator. Increased to 114 in the first quarter of 2018 from 114 in the fourth quarter. So that's measuring prices. We are seeing that inflation come up. inflation expectations. Why don't they tell us now? Last. I guess that's last. Inflation rate 2.4%. I mean, CPI is slightly down. Core consumer prices slightly up. Core inflation rate up by zero point 0.3. GDP deflator down by 0.442 by 44. Interesting. They remain pretty much the same, except for exporting for a little bit cheaper. Food inflation is gone down supposedly. CPI housing utilities has gone up a little bit. Transportation has gone up a little bit. Core producers up a little bit. So we're pretty much just up a little bit for everything. Considered a key indicator in inflationary pressures. This page provides the latest reports for the US GDP. So, well, we still beat the GDP. Um, it needs to update. So, we did get that 2% on April 26th. This increase was offset by a decline in the nowcast real non-residential equipment investment growth from 7% to 4% after the durable goods. So what this durable goods number is showing us is that there's less spending where it needs to go. For businesses to actually be buying the equipment to produce. Yes, there is more business investment, but will that really hold true here? I'm really curious to see what today's doing, because right now we have um, Amazon and Facebook just absolutely popping off, hitting highs here. 1664 on Amazon, 177. Facebook is looking to just go ahead and break through that 178 resistance, but Amazon has no resistance above its head until 2000, guys, and that's the 161%. So, what the fuck is going on? Overall, I would say the data is mixed. It's not really extremely bearish, but it's not really extremely bullish at the same time. So, with all that good stuff being said, we're just going to have to wait and see what the direction happens during the day. And also, we haven't even seen any sort of slowdown from this morning's action. Again, though, what comes up must come down. We actually got a very interesting sign here for Apple. Uh, Supposedly, the CCI is so low, but they haven't entered a bear cycle, so who knows? They might enter a slight bullish phase, which will lead to a downturn, but um, right now the Dow is taking a nice step back up, as well as the S&P. So it doesn't look like we are going to get any pullbacks right this second. we are stepping into overbought territories. So this run is going to continue increasing, and it all depends on where support held. If we got these stocks rising up like this, what is where are they going to find support is most likely at high levels. Um, and that's that. This market is definitely at this point we're close to spiking out with that CCI. So eventually we're going to have to come down. Now, we could get a solid. I thought we were going to get a tiny pullback, like right here, perhaps. You know, tiny pullback, resetting indicators, allowing the markets to take a natural little breather. But what looks like it's going to happen is a dramatic increase until we're spiked out with the CCI. But can we get that dramatic increase? Can we get those higher highs, guys? When the CCI is spiked out this much, you know, it all depends. To me, it's very possible today could break that higher high segment, and this movement could get us out of so-called trouble. Again, though, I really think there was malicious activity at the bottom of this dip. All the signs were pointing to negative. We actually were negative until they just brought prices up. Buyers were there, regardless who their buyers were. So that's what we're looking at. Um, Gold has finally gotten some support as well as silver. So, I mean, that's a nice sign to see. I don't know. I don't think this pace is gonna go anywhere, but it's good to see these get support at critical levels and continue to move in a positive manner. Now, let's check the dollar. We got that we got the 10-year minus the 2-year at 0.54. I'm expecting to go 0.58, 0.56. Again, let's go ahead and check out Dixie. Dixie should continue to rise here. We are backing down exactly that 92 resistance, so we're just going to have to see. We could just pop above. That's what I figured we would do, is just pop above that resistance and call it a day. We slightly did. We popped above it, and we're getting support, so we should continue to see a fight above resistance. And that's that. Futures look pretty nice here. Even though the Dow's negative, we're still getting appears to be a higher high. If we can make it on the Dow, that the S&P's disappeared. Well, the S&P just pretty much was absolutely flat. I mean, I think it's because I just fucked up this chart. Hold on, guys. Give me a second. Yeah, we pretty much did a cup pattern and are failing this breakout. I mean, it's possible we could go forward. There's no telling what could happen. I would assume that we would just continue to increase. Um, the CCI here is spiked out, but we still could bounce up again. CCI here is not fully out of the waters yet, so that's a pretty bullish indicator. And let's just go ahead and check that Nasdaq futures getting support here, and looks like we're just resetting those indicators and setting up for Nasdaq being the percent gainer of today. So thank you very much. Please like and subscribe. Hope you enjoyed that economic information, and I will see you around possibly 10 o'clock for some for the consumer sentiment, which is expected to remain unchanged, or increase rather, at 98. So meanwhile, we got an increase on the consumer confidence, a different poll earlier this week. So thank you very much, guys. this economic data is it's okay, but it does show that the consumer spending is being sluggish, and this business investment might not pan out. So you see the increases, yeah. So thank you very much, guys, and I will see you 9:30, 10 o'clock. Yeah, it's more around 10, 10:30. So take care, guys.